Yeah. Well, that's what you hope
Like I said,
for.
I can't even remember.
You hope for your own reputation to precede
Yes.
anything
Your own
else.
personal brand, yeah.
Correct.
That's right.
That won't work.
But you don't, obviously, you don't, office and
Together?
Jason's building.
Yeah,
and-
we don't at the moment. So we are going to build a building for both groups because it is a
Oh,
little
okay.
silly for us to have this office and him to have that
Yeah,
one.
yeah.
Because we do have a lot of collaboration that's naturally happened over the last few years. So we're going to put everybody into one space.
Okay.
But yeah, we hadn't always. But I never, I'm not really big on competitors. I think there's a lot of people. I think everybody meshes well with different people.
Right.
So you're going to kind of find your people, and that's who you're going to work with. But we actually started meeting each other over some charity work. We were trying to raise some money for people, and there were some things that he needed help with, and there were some things that I needed help with. We're very different. Our strengths are very different. And I was like, well, what does this look like? Just throwing it out there. What does this look like? And so we kind of courted on that for 14 months.
Oh my gosh.
And no one knew until 2 days before. And then our phones started blowing up.
Yeah.
And so the very last day, it was like 3 p.m. He's like, my phone won't stop ringing. I was like, I tell you what. I said, why don't you turn it off and we'll go to Bay Oaks and just play golf. I said, the day will end.
Right.
And then tomorrow we can take care of business and everybody will know.
Yeah.
And he was like, okay.
Yeah, good plan.
Yeah, I mean, what else are you going to do?
Right.
Because if not, you're just going to agonize over it,
Right.
He was such a great mentor to us when we were planning to build our office in League City because he had just gone through the process.
And they're difficult.
His place, and he
Big time.
he really warned us of a lot of what to expect that we wouldn't have thought of ourselves. Yeah, he was I think, was that 2015 or 16? I don't remember.
That sounds right, because he's been in his building 7 years last month.
Okay, that helps me with the timeline.
So probably 16.
Because, that's about when we picked up the League City Parkway property.
God, was it that long ago?
It all goes like that, man. It's crazy.
Yeah, and then of course, 16, 17, and Harvey hits, and then we're dealing with that for a couple of years.
So because obviously the neighborhood I live in,
Yep.
my house flooded.
Yeah.
Yeah.
I wasn't one of the 3 lucky people.
Yeah, I got it.
So that was interesting. And after we got our house ripped out and dried out, I told my wife, I was like, I just have to go back to work. Because if I don't go back to work, like tomorrow, my group is not working. And that's not going to work. We have all, I understand, most of us did not flood that work there, obviously. So I was kind of odd man out. Like me and 2 other people had water damage. Everybody else was fine. At the time, I think we only had 12 people. But those 9 people need to go back to work. And I knew that they weren't going to until I got there. Because we were all helping people, right?
Yes.
But after about a week or 2, we were like, okay, now we have to, all of the properties that didn't flood that we had contracts on, we need to get them re-inspected and close them.
Right.
So that started that.
Crazy time.
And that really trained us for I feel like we've had one of those every year almost.
I know.
Like the free,
We haven't had a normal real estate cycle since.
I mean the freeze was a whole thing too. Everybody had to get re-inspected.
Yes.
Right, right.
Yes.
So I'm just about done with having once in a lifetime weather events.
I know.
I feel like I'm living one every year.
Exactly.
Yeah.
I'm holding my breath this year.
Yeah.
Right.
You ready?
We've been recording.
Okay. So audio and everything's good? Okay. Well, since it's rolling, we'll just start with whatever questions you guys have. We'll just go back and forth, and then once we get done with the questions you have, we'll just kind of open up what's our story? What brings you here? What's the community part of it? You know what I mean? Because you don't stay in business this long without being plugged into your community some.
Absolutely.
You just don't. I don't think so.
Right.
So,
I agree.
so whenever y'all are ready, we'll start with whatever questions you have.
Actually, you know what makes
What are you gonna do? There you go.
Ready to roll?
Yeah.
Well, I'll start. I had something that I've been thinking about lately and wanted to ask about. When I got into the business in 2003, that was right at the real estate boom.
Mm-hmm.
And I recall many homeowners, in regards to mortgages, chose an adjustable rate mortgage at that time, what we call an ARM.
Sure.
And that was due to, again, rising
Mm-hmm.
prices, somewhat of a lack of inventory, not really what we're experiencing now. But fast forward to 2022, and I believe it's close to 90% of homeowner mortgages today are fixed interest rates.
Mm-hmm.
So with the real estate industry changing now and affordability for homeowners being somewhat of an issue, or could be an issue, do you see adjustable rate mortgages returning for those homeowners who would like to try to get into a home? I know it's a risk,
Mm-hmm.
but do you see those returning at all to the market, and where do you see maybe that going?
Yeah, that's a great question. And we're already seeing them return on jumbo products right now. Chase, US Bank, they're very aggressively priced on the jumbo product with adjustable rate mortgages right now. So we're starting to see people take advantage of those. We have changed in the lending world. I was in it in 2002. That was my first year. So on the lending side, the way we used to qualify people when they used an adjustable rate mortgage and the way we do now is completely different. Now you have to qualify on the completely adjusted rate, right? So it's like whatever you qualify for plus 2 or 3%. If you qualify for that, then we will give you the adjustable rate mortgage.
Interesting, because it was not like that
It
in
was not that way.
2003.
Yeah.
When I got into the industry.
Correct.
A lot of home
It's good
buyers
to hear, actually.
were easily,
Oh,
or more
makes it feel a
easily
little better.
qualified on
Right.
an ARM versus a fixed mortgage.
Right. So we're really,
Interesting.
yeah, we're really focused on affordability past the adjustments now. It wasn't that way before. Before it was just, if this number makes the system say yes, we're going to run.
Right.
But now it's very much, and a lot of that came from, Dodd-Frank and some of the additional regulation. It was like, if we're going to do these loans, then we want to see that people can not just afford the minimum payment, but they're going to be able to afford the adjusted payments. So we're going to take whatever the ARM rate is plus 2 or 3%, that's now your qualifying rate. So if they can still pay that, like let's say today instead of a 5, you would get a 4. They would say, well, if you can't pay a 7, you don't get it. If you can afford a 7, we'll give you the 4. And it's lower and you can play the market a little bit, right? The other thing is the terms on the ARMs are a lot different now. We used to do a lot of 2-year ARMs.
Right.
The 3 is still there, but 7-year is a good ARM. A lot of people don't stay in their home 7 years, right? So 7 years is not a super high risk product because you're probably not living there still. You can even do 10-year. So if you do those and you save a little bit of money, likelihood that there's going to be a risk there is low. So I think they've adjusted the way the product functions to where it can have a place in the market. We're not seeing a ton of it right now because there's been a lack of liquidity in the secondary market when it comes to ARMs, because most people that would use an ARM right now would use it to go from like a 5 to a 4.5, right? Well, if rates go to 4, they're going to refinance that. So they don't want to buy those. Not a lot of liquidity in it. When we get into a stabilized rate market, kind of like we had in that mid-2000s, and also, to be honest, 2010 to 19, rates were kind of the same all the time, right? So when we get into that, then you start seeing investors put liquidity into adjustable rate mortgages where you might save 0.5%. And for maybe a veteran, right? Veteran, if they're PCSing, they have a 3-year deal, maybe they take a 7-year ARM. They're not going to be here. That even covers if they get signed up for a second term here. That would cover them. So I think there's a place for them, but the way that we execute them now is a lot safer on the back end. So they're not going to get hit with something that they never really could afford to begin with.
That's good to hear. Obviously, that's the thing that we talk about quite a bit is prices escalating the way they had just in the past 2 years.
Yep.
Insane, 15% year over year kind of stuff, which I think we're finally starting to see kind of a rollover.
Sure.
Based on HAR's most recent numbers. But you worry about, we have this huge millennial generation, and they're all home buyers now, or want to be.
Yep.
But obviously never having owned a home, I think they have in mind the price of the home, and they can kind of, that's what they kind of fixate on. I'm thinking back to us when we first bought our first home. We were just all drilled into, okay, what's a monthly payment?
Yeah.
What's monthly payment? What's monthly, can't afford it?
Yeah.
And then taxes go up, or insurance.
Everything
creeps
goes up.
which all of those are creeping up. So we worry about these young folks, our sons, getting into a home, and if they do some kind of some kind of a flexible
Payment.
Yeah.
Yeah.
And then you
What's
have
that gonna
taxes
look like?
and insurance hit them, and okay, now we're looking at another kind of problem with foreclosures. But qualifying them at the higher expected rate, I guess. And there's a question: is that 2 to 3? Is that a
Depending on the program, it's going to be between that 2 and 3%.
Yeah.
So if you're doing an adjustable rate mortgage, and let's say it's a 5-year adjustable, and your first adjustment can be up to 2%, well, they're going to make sure you can absorb that 2% on your qualifying. Yeah. And the reason is that gives you a whole year to refinance, right? If you have a 2% adjustment, you can afford. We know that you can afford that, and likelihood is if it's a 5-year adjustable, by year 6, likelihood is that your earnings are better. Potentially, your debt load is more manageable. As we get older, most of the time, we're managing our finances a little bit better. So the idea is that you would be able, if you could afford it then, you should definitely be able to afford it 3 to 5 years from now.
So in that same line of thought, then you say you've seen a few of those, you guys, ARMs. What are there other, I guess, creative financing vehicles that you guys are finding useful to help these, the young, particularly the millennials? I think those are the ones that are being impacted the most.
Sure.
And being pulled out of the market because they have so much competition between price escalation, these huge investor, institutional money coming in and buying up entire freaking neighborhoods.
Yep.
And then of course, these, I call them rogue states that basically went locked down
Transient.
forever. Yeah, and so
Transient
so
buyers.
Lost a lot of population.
Yeah.
Who have, we've been so blessed here in Texas, we still are. But obviously we're shouldering now.
Sure.
We're seeing the repercussions of all of that.
Of the money.
Yeah, and so what does that do to those those first-time home buyers? What are you guys using to help get those folks into properties, or is it, how do we help them, I guess?
Right. So two
Such a
things.
challenge.
Yeah. So 2 things. I don't think we can help them on price.
Yeah.
Because if history tells us anything, prices might get stagnant when rates go up. Do we think they will go down? Maybe not. Probably level. And if rates go back down, we expect them to probably start to go up again for price. So the most difficult situation for our current group of first-time home buyers, which is one of the largest groups of home buyers ever in the history of the planet, is you have to understand 2003 you start, 2002 I start. We've seen 6, 7, whatever. A 24-year-old home buyer has only really seen rates at 3 or so. They've not experienced anything other than that. And it's hard to tell them that rates have only been in the 2s ever in the history of mortgages for 18 months, and we just lived it.
That's insane.
And they're really not supposed to be there.
Right.
They don't deserve to be there. That was 100% a please don't collapse the economy measure. So a return, my rule of thumb is 4%, right? If you have 4% rates, 4% unemployment, and 4% appreciation, things just kind of run, okay? So when we get there, you have to be prepared to pay 4% in interest. One of the things that I think right now, in this moment, and we're talking August 2022, I think there's an opportunity for buyers where you have a little bit less competition. I think we have a little bit more inventory. And if you can stomach a high 4, right, the rates might come back to us. I don't think they're going to be that low. but I think the rates could come back to 4 on the other side of whatever our recovery is. And you can always fix that. But when they go back down, prices are likely to go up. We can never go back in time and buy the house for less, right? So one of the products that we've used, and it's really an old product that just recently has had a new purpose, and that's not a permanent buy down, but a temporary rate buy down. So it's not an adjustable rate because it's still fixed. But let's say you are a brand new homeowner and you qualify for a 5% rate. There are some homes that are having price reductions or improvements. So if you target homes that are sitting a couple of weeks and have price improvements, instead of taking a $10,000 reduction, which is only going to save them $60, $70, you could ask for a seller paid temporary buy down. Okay? It's probably going to net the seller a higher net sheet. So instead of 10 grand, it might cost them 7,500. Okay? You ask the seller for the temporary buy down, and what it does is it mitigates that rate for the first 2 years. So it's still a fixed rate product, but if you qualified at 5, year 1 you'd have a 3%. So it helps them ease into the payment of home ownership. Year 1's 3, year 2 is 4, and then it's 5 forever. We think by the time you get to 5, rates are probably low enough to refinance. But if every economist in the world is wrong and they go to 8, you still have 5.
Right.
So you're getting to hedge both sides of the market. And what happens is you don't have to reduce the price, right? Because you're giving a concession instead. So it's likely that the seller net sheet's higher. You don't drive the price down of the neighborhood. And the buyer is saving anywhere from $400 to $500 a month year 1 versus $60, $70 a month for a price reduction. So we're using that product a lot right now on our first-time home buyers to kind of ease them into that payment. Because if you have someone that's like, look, I'm going to wait this out, $70 doesn't get them off the couch, but $500 gets them interested in buying. And right now they've got an opportunity because there's less competition. But again, we're qualifying them on the fixed payment year 3. We're just subsidizing year 1 and 2. So they get to ease into the payment.
When you say that's an older product?
It's an old
it's
product.
come back?
Oh yeah, they were using that when I started.
Wow.
So it's a
That's
seller
great.
temporary buy down.
Mhm.
It's the same as kind of like a contribution.
Same as a concession.
Same
Concession.
paragraph.
Same as you still use the 121AB.
$500 directed towards
Yep,
a buy down for the
correct.
loan officer or the mortgage broker to.
Yep. So you're going to put it in your same concession spot, and then special provisions. It'll be credited towards seller paid buy down. And instead of a permanent buy down, which is where you might pay a point, right, which is 1% of the loan amount, for a 1/4 point off your rate, you're paying whatever, it comes out to about 2.5% from the seller, right? You're going to get that money from the seller, and you're going to point off your rate year 1, and 2 points off your rate year 1, and a point off your rate year 2. And then when you get to year 3, you have the fixed forever. If rates are higher, keep it, keep the 5.
Right.
If rates are lower, refinance. We're working on a pipeline of people right now to create affordability, and we're going to have title companies partner with us to reduce fees, make it easy for them. We're paying for their appraisals on the refis. We're keeping them in a drip campaign. So it's all about, like, let's get you in now and make sure that we can continue affordability later. But they have a chance right now to buy when there's less people
Right.
involved.
So that's obviously a conventional loan and what?
I can do that on conventional, FHA, VA, or USDA.
Oh, that's great. I wasn't expecting that.
Yeah. Well, it's all about how your company is set up, because you have to be set up with the ability to subsidize the payment, right? So my note rate might be 5%, but we're taking that money from the seller, putting it in escrow, and we're subsidizing it to 3% year 1, 4% year 2. Now, here's the really cool part, and this is where I really think everybody wins. Let's say rates go down a lot, and they still have money left. Well, you don't want to leave that on the table. So if they got 8 grand from the seller, but they've only used 5, that 3 grand when they refinance is a principal reduction. So they never lose the money. Where if you bought the point, if you paid a point, 1%, to buy your interest rate down, if you paid $4,000 to buy it down and you refi, you lose it. It's gone. But on this, at least you get it as a principal reduction. So everybody that we, right now it is, and it has a place. Every product has a place in a market, and I feel like this one has its place right now. Will it still be used when rates go back down? Probably not. Because when rates were 3, nobody cared about getting a 1.
Right.
You know, you can afford it. It's no big deal. But right now, mentally, optically, we don't like seeing 5 and 6%.
Right.
We want lower. So this gives them the ability to get in.
Under 5.
Good one.
I mean, it could be as low as 3 something right now.
Yeah.
Because, I mean, I have given, I don't even think I can say this on a camera, so I'll say it and then I'll have compliance look at it. We've had,
I'm gonna itch.
yeah. Well, what I was going to say is like, we've had some of our veteran clients and high qualified conventional clients and high qualified FHA clients. In the last month, there's been liquidity returned to the secondary market for mortgage-backed securities. So we've seen some high 4s, right? High to mid 4s. If you use this product too, now it's high to mid 2s, year 1. So now you can take someone that has that in their head and you're like, well, we can give it to you for a year. Then you go high 3s, then you go high 4s, right? But you're going to stair step with me. And then it's for forever. Or if it goes lower than that, you do the refinance later.
Yeah.
So, I mean, it still can be extremely competitive. That saves them a ton of money first 2 years.
So why wouldn't a second home buyer or a veteran home buyer use that program, or do they?
They do use them. We're starting, it comes through education, right? I'm doing these videos. I'm going to talk to teams like yours every week. No one's heard of it. So right now, I'm this lone ranger out there trying to educate everybody in our market about this product.
Well, and getting a seller concession hasn't been the easiest thing over the past 2 years either.
Sure, but now if you're targeting, well, or the other thing is, we just reduced it 10 grand. Okay, well, how about I offer you 8 over where you are now,
Right.
and you give me that concession? You just reduced it.
Yeah.
It's the same thing. I mean, you know it's the same.
get it.
It's money here, money
Yes.
here,
Right.
right?
Right.
So that seller, if you're already from 330 to 320, if I give you 328 and you give me the 8 back, it's the same.
Mm-hmm.
And
So you
educate
can
your
target those.
buyers
Yes.
on not necessarily
You target.
targeting that hot property that hit the market this morning and they have 6 or 7 offers.
And I think in 30 to 60 days, when they're starting to do their searches, we've got to get rid of the stigma that if it's been around 8 days, there's a problem with it,
Yeah.
Right.
right? So we're starting to
Absolutely.
we're starting to get to that point where
We
people
are.
are like, well, it's not that, it's just a normal real estate market.
Right.
We're now back to what we like to call reality.
Right.
And, you know, the last 2 years were great, but selling your home in
Sustainable.
4 hours with 70 offers is not where we live now. But there's still a market, there's still an established market, and I think it's still very strong
Mm-hmm.
in our area. But things are going to garner the price that they should, not 50,000 over. And the other thing I would say to a millennial buyer is, would you rather pay 50,000 over at 3% or the current price at a high 4? If you do the math, you would not break even for 9 years. So be competitive in a market that's probably lends itself a little better to you.
Right. Good point.
Good information. Good stuff.
Any other questions from you guys? Have you ever heard of that product?
No.
No.
Everybody I talk to has never heard of
Doesn't
it.
have a name. You know,
It's
like
just,
said,
it literally is just called a temporary buy down.
Buy down.
And you can use it on conventional, FHA, VA, or USDA. The whole trick is, it only makes financial sense if the seller pays for it. That has not been an option the last 3 years. So now that we're transitioning,
Yes.
this has a place. It's
Yeah.
got a powerful place.
That's great. That's great to know.
It has a powerful place.
Have you guys, I don't remember where we heard this, maybe I read it somewhere, that there's now, and I don't remember the term, was it a 40-year or what, but extended beyond 30?
40-year
Loans.
fixed mortgages.
Mhm.
Are you seeing those, and what are your thoughts on those?
My thoughts on those aren't
I
great.
can imagine, obviously, like you said, sticking you in the same place for even 7 years.
Right.
Yeah.
These days, it's just
So it's another
long time.
it's another situation where, as an investment firm, why would I pay a premium for a 40-year mortgage when I know they're not going to be in it past 5 to 7 years? So what we're seeing is the pricing is not that much better, and believe it or not, if you look at an amortization schedule, stretching it out from 30 to 40, the savings is not significant.
Yeah, I would imagine.
It really is. It's not like going 15 to 30.
15 to 30.
Right.
30 to 40 is not that much of a savings.
Right.
And I don't know that it, I mean, I guess we're living longer, but I don't know that making people qualify on a 40-year term is the right thing to do.
Right.
You know, I mean, the word mortgage comes from death contract, right? That's how it's directly related. I don't think we should really be enforcing that.
Yeah, no doubt.
But 40-year mortgage feels like
Right. Oh,
that's what it would be, you know? Could you imagine being, you know, 55 or 60 and downsizing into a 40-year mortgage?
Mm.
No way, man. I don't think it's a smart thing. I don't know what the long-term answer is to affordability because things are going to continue to go up. The ultimate answer is we have to find a way to, as a society, create value where we can demand good pay. Because you have to make money to keep up with inflation, period, right? And I think that this will get into something completely different, but you know, you have to relook at the model of like, do you go to school and get this degree? And are you able to leverage that for the amount of debt that you took out and the time that you missed making money and learning real life experience? Does that leverage anymore? We have to rethink if that model makes sense. Because, I mean, people that learn a trade, I've told my son's 14, right? My daughter's a sophomore at A&M. My daughter is made to work at a company, okay?
Yeah.
She's studying zoology. She wants to work with exotic animals. She loves it. She'll be able to do that and provide, right? My son is different. My son has an entrepreneurial spirit. I love it. And what I've tried to tell him is, I said, son, the only way that you're going to be able to provide for you and anyone else that depends on you is you have to learn a skill. And it doesn't matter if it's with your mind, your heart, or your hands, but you got to become extremely good at something that you can leverage so that people need it. And if you can make it something that's fun at the same time, great. You know, try to do that. But we've got to rethink that whole model, you know. And it's tough. I never thought I would tell my 14-year-old, like, look, if it's not for you, it's not for you. But you got to learn to do something. But that's...
In the short time, you know, we do the same thing with our boys. You know, we send them to Texas Tech. And, you know, when was that, 2012 they left? So not long ago, just within the past 10 years, but my perspective's totally changed.
Yes.
I don't know if you can leverage it anymore. I don't know if you can, when you look at ROI, the ROI on university studies is not what it used to be. Used to be, and some of it is because of cost,
Exactly.
right?
Yes.
When it was $5,000 a year and you spend 20 to go make 65 year one, that makes sense.
Right.
But when you're paying 25,000, 30,000, 40,000 a year, you never leverage it out.
That's right.
And then they get into student loans that are a whole nother thing. And so, you know, we're trying to make sure that we don't want our kids to graduate with student loans, if there's any way that they can avoid it. And, you know, that's a personal choice of ours because being in our industry, I see people all the time. We see mid-level healthcare workers with $250,000 in student loans, and they can't buy a home.
Right.
And I don't think that's right. I don't think they should be able to lend a person that has no income $250,000 to get a job that pays $70,000.
Right.
And I think that institution's broken.
I think there are a lot of Americans and families revisiting and having this discussion for those same reasons.
Well, what's difficult is when, you know, usually most families, some are blessed with more, but most families only get to have 3 generations at a time, right? So when your oldest generation had a way that worked, and then the middle generation is where it started to change, and then the youngest generation, it doesn't work. It's really hard to have those conversations because, you know, you're only 2 generations away from things changing completely at any time. Ideologies, anything. So when the whole game changes in 2 generations, it's hard. It's hard for us to be like, well, that was good for me, but it's not for you. And it's even harder for a child that is not fully developed mentally to be like, well, why is that so?
Right.
Why was it okay for you and not me?
Right.
It's a different time. The world is completely different, you know?
Moving ever so quickly, more so than our parents' generation.
Well,
and
you
our
know.
generation with technology. You know, it's harder and harder to keep up with how quick things are changing. So I had a question. Today being Thursday, August 11th, 2022, what are today's rates, average 30-year fixed? Because I have a feeling we may look back on this video in 3 to 6 months and be curious about this subject. And I've seen over the past 6 weeks on various real estate contracts anywhere from 6.25 to yesterday 4.65.
So we have locked some loans on 30-year contracts anywhere from 4.6 to, like you said. And on the first-time home buyer, maybe down payment assistance programs, and maybe even higher than what you're talking about. We've even seen sevens on some of those contracts. I would say on your really good qualified buyer today, you're looking at that mid to high fours, which is palatable, right? I don't know if it's going to stay there. I believe that this last 2 weeks, we've had a temporary reprieve because with the inflation report that came out yesterday, we had priced in a much higher hike than we think that they will do since inflation has cooled somewhat. But I don't think we can take a victory lap yet, because if you really strip out energy and what's the other one? Energy and like produce, if you take those two things out of the equation, it actually went up again 0.3%. Gasoline's off 17%. That was 80% of the reduction of the inflation report. There's a lot of reasons people use less oil. One could be because it's too damn expensive. So if people just drive less because it costs more, okay, it comes down a little bit, right? And that is kind of how economies fix themselves. Now there's more supply because people refuse to pay for it, so now you have to lower the price because you have more. But we're not seeing that in grocery stores yet. Your eggs are still expensive. Eggs, dairy, meat, produce still out through the roof. When we start to see those come down, that's when we know inflation is coming down. We have some indicators now that's showing there's some relief, and because of that, we don't think the Fed is going to act as aggressively. That lets us have a little bit of rate reprieve.
Right.
But if we don't see lasting results on the next report, they could go right back up. So we don't know. I'm not ready to take a victory lap yet on one good report.
I would agree.
Because you strip some of these things out, like we can see with our eyes faster than the reports can manage expectations, right? I still have to pay $5 for milk, even if inflation came down 2%.
Right.
So that, to me, it's not there yet. But, you know, you do have lumber 60% off where it was in March. Steel's off 30%. Building materials are coming down. So you could start seeing some of that, which will stimulate the economy too.
Right.
Unemployment numbers did go up a little bit. In the jobs report that we had last week that looked awesome, 500,000, half of those are part-time workers. So when you strip that stuff out, continued unemployment was up by 0.1%. So I don't know yet. I think
Yes.
it's good to see something go in the right direction,
Right.
and I'm hoping it's the first domino.
Right.
And if it is, great.
But I agree, not a victory lap
No,
yet.
not yet.
I read recently that the American household debt has risen to $16 trillion in the second quarter, predominantly mortgage rates, auto loans, student debt, and then day-to-day living. So it appears that a lot of Americans are starting to charge credit cards again to find relief in that day-to-day living, which, you know, could possibly affect, again, future housing because debt-to-income ratios change and they are, you know, charging just to live day-to-day.
Well, the short-term revolving accounts and auto loans are the first ones to be affected by the Fed rate.
Right.
So not only are they charging more, but they're charging at a higher percentage rate. So that has secondary and tertiary effects that take months to catch up with people. The one thing that we have going for us is most equity we've ever had in homes. So you might see some people shed their 3% rate for a 5% to do a cash out and pay their debt off. It's still a vehicle that makes sense because math doesn't lie. If you got 2,000 going out and I can make it 1,500, that makes sense. Because at the end of the day, it's money in, money out.
Right.
Doesn't matter what your interest rate is. So I think that's still a vehicle that we're going to be using probably come spring. I think you'll start seeing that pick up.
I'm glad you mentioned that. I don't think that we talk about that enough for homeowners who don't plan to move or sell anytime soon, but want to take advantage of the equity they have in their home to be a little bit more comfortable in their day-to-day expenses.
Yeah, I mean, you
paying
can,
off debt.
you can weaponize it. And the other thing that people don't think about is if you're not if you're like making it okay, but you have a lot of revolving debt, it might even make sense to pay it all off and put it on a 15-year. So then now it's all into a fixed rate, but now it's on a 15-year term that's gonna be done. And you accumulate equity at such a faster pace. Where, you know, now credit card companies have to disclose to you if you make the minimum payment, this is how much it will cost.
Right.
So we do have people that are paying attention at least now. But the cash out refinance will always have a place because we're a debting nation. We're just a nation of debt. We want it now and we'll pay for it later.
Right.
So your equity in your home, and anyone that's not buying right now, you don't have this option because you're not accumulating wealth through your real estate. That's maybe another thing we can educate millennials on. This is a good weapon to put to use to offset your debt. We've been doing that. We've been doing that forever. It's still going to be lower rate than anything you're paying on your credit cards.
Right.
No doubt.
If you get a cash out refinance tomorrow at 5%, it's going to beat every credit card in your wallet.
Right.
Period. So there's always going to be a need for it. And right now we have the most equity we've ever had. We have the most debt too. So those two are going to have to battle it out at some point. But at least you have. But at least you have the option
Yeah.
if you're a homeowner.
Yeah. Exactly.
Good stuff.
Great to keep in mind.
Yeah. Well, we'll clap for that. And we appreciate you guys being here. We're not gonna say bye. We're gonna do the other part. Do you want to turn the fan on for a minute?
Oh, I'm good.
Okay.
Actually.
Just double checking. Okay. I'm gonna uncross my legs for a second. Is this framed fine?
Yep.
Okay. I'm gonna switch legs.
Yeah.
I really appreciate you guys coming.
Yeah, man.
Yeah, it's
Yeah.
interesting. It's good to change it up. You get in a rut day to day. You know, you do. So it's, this definitely was a change up. I think Beau remembered yesterday what we got tomorrow. Oh, got that video. Okay, what do we have in the morning? So
You got something Thursday.
Yeah.
You got something Thursday.
Yeah.
it's,
Well, I'm glad you made it.
yeah, it's nice to, change it up.
And for me, it's nice to get everyone's perspective because I'm not doing this to get people's business. I'm doing it to learn. You know what I mean? Like, y'all's business and how you run it's different. Everybody's different. What are you seeing? What are y'all seeing that I'm not seeing? So for me, it's value. You guys get some videos out of it. We get to know each other a little bit, but also, if nothing else, now you know about that product.
Well, I was going to go back to what you said earlier was educate. I love that you are educating even a seasoned realtor, 2 seasoned realtors. I love that you're educating us as well. It's, you're learning something.
Absolutely.
From us, but as you mentioned, that product and your perspective on the market. And
Yeah.
where we are. And the economy and consumer confidence and all those things that are part of our business
Yeah.
day to day. It's good to sit down with someone in the industry from a different aspect.
Sure.
And talk about everything that we talk about every day in our business and someone in the mortgage side.
Yeah, I appreciate that. I'm somewhat of an eternal optimist, so I can be a little annoying when the housing market appears a certain way to other people. There's opportunity in everything.
Yeah.
In
You know,
everything.
I can appreciate that because you and I both got in the real estate industry and the real estate mortgage market about the same time. So we've seen so many levels and so many aspects. And I remember in 2008, I was at Remax Space Center with a lot of wonderful seasoned agents, some of them still there today. and literally running around. It was August of 2008, and Countrywide had declared bankruptcy.
Mm-hmm.
And you would have thought the sky was falling.
Oh, yeah.
And I remember them just, oh, this is it. I've got to get out of the business. This is the end of it. And I remember thinking, well, I've been in it for a short time. How can I take this and turn it around and be the best in my area? I didn't know what I was afraid of because of the inexperience in just coming in, where they had, you know,
Sure.
been in an easier market. I didn't really understand, so I used that to my advantage and just seemed to work a lot harder at
Sure.
that time and pulling out of those. But so I think just going back to being, you know, optimistic. I feel like I've been through just about every market in real estate in 20 years, which is a short time.
Sure.
In addition to Hurricane Ike almost destroying Galveston County, which is a big part of our market.
Mm-hmm.
The photos devastating, the damage, the property damage. I thought, how are we going to come back from that? That was '09.
Mm-hmm.
Then we had Harvey in 17, and then the freeze that we talked about. So in between those major events in our local real estate market, then you add, you know, the fluctuation of the interest rates and the economy and the changing of administration and the
COVID.
consumer confidence. So through 20 years of a real estate roller coaster, I still feel very optimistic about any market that we are heading
Mhm.
towards. And I think that just comes with an innate, what's the word, but a part of me that I know I'm a survivor, and I know if you always give first-rate service,
Yep.
you work hard, you run an honest business, you do the right thing by your clients and your customer service and your business relations, that I feel very optimistic that
Yeah.
I can get through any market.
I'm the same way. I think what people don't understand is on the mortgage side of things, and maybe this is the reason I'm so optimistic all the time. When you look at all the different products, I feel like there's something for no matter what's happening. There's some sort of solution that can help no matter what's going on in the market. So I always look at, okay, well, this is what we're doing now. Or, okay, well, this is what we're doing now. But if we cannot get the word out and we can't educate people, then they don't know. I need you guys to tell people about temporary buy-downs. And I need other real estate teams to tell people about temporary buy-downs so that when you bring it to them, they're like, oh, okay, we're doing that? Okay, cool. I mean, it's really a seller concession, but if everybody knew what it was, then when you bring it to them, they're like, oh, okay, we're doing that? Okay, just send it to me, we'll sign off on that. And until we get to that point, it's really hard to execute. So we're having to teach and explain every single time we do it. And we have this really good calculator that just kind of breaks it down for you real quick. And we're having some success, and I think we're going to have another 6 to 9 months where it will have a place in the market, but we just got to keep, I'm just going to keep shouting it, and the more people we can get in front of, the better, because I think it works for right now.
Absolutely, and you know, in real estate, we say there's a buyer for every property.
Sure.
And I think that holds true with the mortgage industry, because going back to 2017, after Harvey, we were all educated on renovation
Oh, yeah.
mortgages and renovation loans. So going back to your point, there's a product for
Everything.
each phase of the market, and same, you know, with real estate. So,
You know-
I remember learning a lot about the renovation
Yeah.
loans and mortgages.
We were even leveraging renovation loans during COVID, because if you couldn't find a 4-2, well, what if you could build it? What if you could take a 3-2 and we add a new master suite? Could we do that? Can we look at a different, like, we're just not finding anything. Okay, well, what if we look at these, but you could build out your master suite however you want? It's just, there's a way.
Yeah.
You know, if you have tenacity, there is a way. And you'll be fine, you know. But I wanted to touch a little bit more on what you were talking about earlier. So you're at Space Center. You're early in your career. You're having success. What was that moment that made you say, and maybe at the time it wasn't, I'm going to do Synergy, because maybe you didn't even know it was Synergy. But I'm going to go do this, and I'm going to do it this way. What was it? What was that thing? Well, first, when was it? And then second, what was it?
So I got my real estate license in 2003. Pretty much hit the ground running, was very green. Worked extremely hard, even as hard as I work today, but as I mentioned, there were a lot of seasoned agents in the business. 2008 came and they started transitioning, out of the business. So I learned a lot of grassroots community involvement early on, and I believe that I have held true to that. I think it's very important. And then when Beau joined me and he got his broker's license and we purchased our own franchise, Remax Synergy, we carried that into our business today. So I think it was about 2010 when I realized, after working 7 years, 7 days a week, 24 hours a day, I realized, I can't be all places all the time to all people and continue to give great customer service. So it was about 2010 that I started thinking about building a team, and I got my first assistant that could handle my paperwork so I could go out and sell more homes. And then about 2012, Beau joined me. He joined my team. He got his license. And then the rest is history, I guess. We bought the franchise. We realized that Remax Space Center was in Clear Lake, and they later opened in Lake City. And I enjoyed being a part of Remax Space Center for many years. I wanted more of a footprint in Lake City.
Sure.
So when we saw opportunity there, that's when we decided to go ahead and purchase our franchise and open it in Lake City, and that's when Beau joined me. So that's how we transitioned from kind of Clear Lake to Lake City area. A lot of growth and booming down there. So he joined me, and from there he started recruiting team agents and growing the business, while I still focused on what I love, what my passion is, and that's working with clients, whether it's showing property and real estate or sitting across from the breakfast table in a very intimate, private, confidential situation where you really have to listen to the client and find out why they're selling, where they want to go, and everything that's a part of their life for that decision that they're making. So still to this day, that's what I focus on most. And Beau holds down the fort at the office.
Yeah.
Yeah, the business side of it, which I never dreamed, so I guess my story behind how I got involved, just never, like we mentioned earlier before we were on camera, we just never dreamed, you'd be doing loans,
No.
mortgage broker or real estate. I knew nothing about the business. So my background was medical. I was a registered nurse, did critical care for about 10 years. While she was launching her, kind of coincided with her. We had twins, and launched a nursing career and launched a real estate career, all pretty much in the time span of about 2 years. So, just jumped in feet first like we always do. But yeah, so I did nursing for about 10 years, and then got into a medical consulting position. I was fortunate enough to try that with a company out of Indiana. So I began training on hospital beds, acute care beds, different products that we sold. And so that was kind of my introduction to business. Prior to that, it's all science. I was just a science nerd and a history nerd, and I loved, just all science. Never thought about business as a registered nurse.
Yeah.
Other than, staffing scenarios, and cost and overtime. But when I got a taste of business and marketing and sales through the medical device company, that's kind of where my ideas started to change a little bit, and my kind of goals. Now, it was a great job. I loved it. It was cush. I could train. I had this kind of small triangle that I traveled, pretty much all of Texas, a little bit of Oklahoma. And so you go to the hospital, I'd work with the nurses who I was familiar with, and it's just a great job. but that's when '09 or 2010, I guess it was 10, when things just, the brakes, you know, hit the economy, and all of our positions were let go. All the clinical consultants, there were 30 of us nationwide with this particular Fortune 500 company, and they released all of those positions. They're scared just like everybody else, so they're clamping down, tightening up. So and that's, believe it or not, I mean, her business is still growing at that time. I think she had, looking at her numbers, she had one hiccup, Rookie of the Year, by the way, she didn't mention that, Remax Space Center. And she ramped up every year. I think '09 was the only year that it was flat. And then 10, you know, continued up and on, and then it just, when we became a team, it doubled. But yeah, she was, I would say it was out of a necessity, you know, that we became a team. Because, I mean, I still to this day don't know how she manages what she does now. But even back then, the caseload or the client load that she could manage, of course, those were the times when she'd literally be on her computer in wee hours of the morning,
Oh, yeah.
3, 4 in the morning, and then, you know, back at it at 8 or 9. So naturally, she needed help, and it just kind of fit, the timing was right. You know, I was in a transition. I knew I didn't want to go back to the hospital. I was 40 at that time, and you know, starting in a critical care or a hospital when you're in your 20s, it's a little different than in your 40s. You know, it's just a different game.
Yeah.
And just being gone that 5 years in the hospital, so much had changed technology-wise.
Sure.
You know, I remember taking a full page of notes on just trying to discharge a patient from the unit versus before, you know, I mean, it was, you know, you just do your basic things. Well, now you have all these different steps, and so it was a different game. So I knew I didn't want to go back to that. Sales were still, those positions were hard to come by. You know, companies weren't hiring. And I liked the marketing and advertising stuff, so started doing some stuff with her on, you know, filming and videoing properties, get a camera and a mic, and we go play around and do these 5-6 minute long videos. It was fun, and I enjoyed it. And I had time to do that when I was doing sales. So I could do some fun stuff with her. But yeah, so then we decided in 2012, let's just go for it.
Yeah.
Let's just go for it. We have nothing to lose.
All in.
We have nothing to lose. I mean, the business was there. Obviously, it was scary, you know, being completely dependent on commission. I'd never been in, you know, I always had my salary, which was a good salary as a nurse, and then of course in the consulting position. So being dependent 100% was a bold leap for both of us. But we made it work. I mean, fortunately, we had a good market in a great area, and we still are fortunate for that. But yeah, I mean, she definitely you know, paved the way with her own brand and just, you know, the way she had attacked the market. But yeah, we grew as it came out of necessity. You know.
Well, I think that, and I'll tell you a little bit about my story in a minute. It's kind of parallel to yours, but no one's going to care about your business more than him, obviously. So that's what makes that great. And then having some leverage, because being the producer, having any amount of leverage means you can go produce more. Right? So a little bit about my story. Same thing. We started around the same time, '02. Did some producing, did some managing. '08 came and I was like, man, I might get out of this. So I worked a little bit in title for like 2 years. I ran a title company. And in 2010, I said, well, I want to go back at it. I'm going to take another run at it. So I had a couple of guys I'd worked with before at Countrywide, right? And we decided, well, let's give it a shot. So we partnered up for about 6 years. 5 of it was great. But when we talk about that moment, like what was the moment that got me to do my own thing versus what I was doing? You know, when we started, it was endless opportunity, right? Like we could do anything. We could build anything. We could create this amazing thing. And, you know, what's all the things we didn't like about our past places, and let's not do any of those, and let's
Right.
make this whole, like, amazing place. And that stayed to be the genuine goal of all three of us for about 5 years. The last year, things started to change. And I was like, look, we haven't opened another location. We haven't really grown. Like, you know, we need to get, maybe not just focus so much on League City. You know, maybe if we go to Sugarland, you know, because Houston's so big.
Right.
Like, if we really want to grow or scale something, maybe we start from scratch somewhere else. No, I don't want to do that. And, you know, some things were changing with loans and rates, and, you know, there wasn't as much revenue there for a couple of years in the mid-teens. And my focus was growth, and their focus was just profit. Doesn't matter. You know, and I don't blame anybody for wanting to make as much as they can for the time they're there, and not really have to work the extra hours. If that's the goal, that's fine, but that wasn't the goal when we came together, right? So now we're not aligned. So I remember I walked through the middle of the office, and everybody just looked beat. You know, nobody had energy. You could tell they didn't want to be there anymore. So I went home and I told my wife, I was like, look, I know things have been pretty good, but, like, I think I have to quit. She was like, what are you talking about? She was like, I don't think so. My wife's a nurse also. She was like, no, that's not going to work for me. I was like, well, okay. So, like, a month later, I came home. I was like, now I'm not happy home. She's like, okay, well, then you have to quit. So I hadn't done a loan since 2010. That was 2016. I didn't really know anyone. I'd been doing operations because I'm an operations person. So day one was me and my wife. That's it. She had learned to process to help a little bit. So we just opened it with faith that we could do it. You know, bet on ourselves. Same thing. She started nursing less and less and helping more and more.
Right.
And when we finally got to a point to where she didn't feel like it was necessary for her to work here, she's like, I'm going to go back to what I love, which is being in the OR. She's an OR nurse. She's like, you're fine. But yeah, that was the story. And now my biggest thing is making sure I don't ever lose sight of that, making it a place that people want to be. So as a leader, you know, like every leader has their thing. Like with your group, I'm sure there's something that you're like, no matter what, we're going to keep this part of our culture strong always. And ours is just, you know, for me, it's if this isn't absolutely the place you want to work, I'll help you pack your box.
Absolutely, that's right.
But I will work my ass off to make sure it is.
Right.
You know, and we've had very low turnover. You know, we've had good growth. We have across Houston, we have 8 offices. We got about 120 people, and we hope to do 500 million this year in loans. Year one, we did 30 million.
Awesome.
But, you know, same thing, grinding, leverage, finding the right people. You know, not everybody's a perfect fit. We've had some come and go, but for the most part, we've learned to find the ones that are the ones that should be here.
Right.
That we're not for everybody,
Right.
but the ones that we do think should be here, I think we've got them here, and that's been a good formula for us. But you'll never see any of that anywhere. Like we're not the bragging type. We're telling a story, so I'll tell you. But you know, we'll never post that. We'll never talk about that stuff. We'll talk about community work because we think that everybody should give back to their community, and we're real big about giving back to our community. We have 2 big events every year that we do. One is the Realtor CE for veterans. That's a big fundraiser for us. And then we do our golf tournament every year in October, which that's grown too. And one of the things that you mentioned that I'm going to touch on, one of our businesses is we have a commercial construction business that does the pneumatic tube systems for hospital pharmacies.
Yeah.
So when you were doing nursing, you had the medicine chest or locker,
Yeah.
right? I don't know why it took so long for them to figure out, but pills come up missing, you know, when it comes time for giving everybody their dosages.
Right.
So now all these hospitals are either building with a centralized pharmacy or they're retrofitting the centralized pharmacy where they have, like when you go to the bank and you send the thing up,
Right.
that's how they get,
The
you know,
meds.
you send down orders now, they pre-package them and they come up through that.
Right.
So you only get exactly what's supposed to go out to the patients now. So when you were talking about things changing, that's one of the things I thought about. I was like, yeah, I mean, I can't believe it worked that way for so long, you know? And there's a lot of that stuff, you know, licenses changed. Everything's so much more regulated now. It's just, you know, you have more to lose, obviously.
Yes.
So, and that's the same in our business too. You know, you guys have Trek, we have Texas SML, Savage and Mortgage Loans. Like there's a lot of risk
Right.
to what we do. Not if you do a good job, but, you know, the reputation over time, if you continue to do a good job and pour into your community and treat your customers and employees right, the rest kind of works. But
It does, and I think it's important to stay in line with your beliefs, your convictions, and what works for your business. And I remember when COVID hit and everyone was, staying home. And at that time, we were looking for our office building, our brick and mortar. We knew that we wanted to no longer lease an office space on I-45, and construction and
Sure.
traffic was terrible. And we were looking for our own commercial building. So I remember a lot of folks in the industry not necessarily trying to talk us out of it, but kind of reminding us that brick and mortar was gone, that, everything is going online, everything is virtual. But he and I talked about it, and being established in our community with an office, a local office where we can hold events for clients, hold events for our agents, team awards and things like that. A place to come together to be involved in charitable work, whether it's preparing meals or accepting Christmas gifts for kids and charities that time of year. We thought it was important, and so that's when we transitioned into our current location, which is Remax Synergy on Calder Drive. And I just have to thank my husband for his vision in that property and what he's done.
Sure.
And it was an old, ugly 1980s house, and we bought it. That's another story, long, very interesting, funny story. We bought it, and all of the renovation was him, and even working with the city on rezoning it commercial and all of the restrictions that entails, and the parking and retaining ditch, things like that. So going back to that was a time when we questioned, okay, everyone seems to be going virtual, and do we really want to continue moving forward with a brick and mortar office in our community, having agents come to the office? And looking back, I'm so thankful that we didn't veer from that, because I think that is a big part of our success. Even through COVID, we continued to hold our weekly or monthly, we did go down to about monthly meetings with staff and agents voluntarily who wanted to.
Yep.
And we just continue that footprint in Leak City and in our community. And I think that's been a big part of our continued success.
Yeah.
And so he's done a great job with our office. And that's one thing that we've held true to is we want, a brick and mortar footprint in our community.
I don't think that meeting in person is going to go out of style. If anything, I think COVID made people want it more. I think we were moving to this like disassociated, don't look at me, I'm going to put my head down and work society. And I think COVID drove us so far into it that now on the rebound, people are like, I need people.
Absolutely.
We understand again that we need human connection. Where we were moving away from it a little bit, I think it's making a comeback, human connection. I mean, we're building a building right now, and you could argue that no one needs one, right? Same thing. But we're building it because we feel like it's the only way you can actually be rooted in your community, period. You know, you got to be able to know, like, there's the Fairway building, there's the Synergy building.
Yes.
You know, we want it to be a landmark in the area.
Right.
And, you know, I personally still want to come in and work every day.
Yeah, I'm the same way, and I think you also people have to be realistic and honest with themselves. Am I as productive at home as I might be?
I would say less than 10% are.
Exactly,
Right.
it's the top producers, and they're top producers.
They're gonna
They're
work no
diligent,
matter
they're
what.
disciplined. Yeah, it doesn't matter where they are, they know what they have to do, and they're driven, they're top producer for a reason. So, yeah, no matter where they are, those people are gonna produce.
Yeah.
But the overwhelming majority of us, myself included, I need interaction, I need that vibe, I need to get out of my comfort zone, which is the house,
Mm-hmm.
you know, so.
Well, how do you train a new person? How do you train a new person virtually?
No doubt.
Right.
You got to be in the chaos to learn.
Right.
You got to be around the conversations. You have to be listening to other people's problems so that you can learn. And if you're not, if you're just at home, how do they even learn how to write a contract on your side?
That's right.
And on my side, how do they learn how to do anything loan related? You know, we have a 1,000,000-point checklist. If you're not in here learning every day, how do you do it?
Right.
I don't know how to train somebody via Zoom for what we do.
Right.
There's just too many points of inflection. There's too many things that can change. There's too many variables to not have this and appropriately learn this business,
Right.
in my opinion. If you're going to do it right.
Yeah.
Right.
If you're going to really serve clients the right way, there's
Absolutely.
too much to learn to do it virtually.
Mm-hmm.
Our weekly meetings at our office are typically on Wednesdays, and Beau and I will usually discuss, updates in the industry, local real estate news, any revisions to TREC forms,
Mhm.
and kind of a mini educational session, and then we get into open discussion. And open discussion is my favorite because all of our agents, have the opportunity to share something, maybe that happened that week or an open house or situation. And just going back last week, one of the topics, I thought, wow, in 20 years, I'd not experienced that or heard that. And without that, the collaboration and the networking together within our office, how do you continue to learn and
Sure.
grow and transition, as a professional or as a team or as a company?
Yeah.
So,
Well, I think leaders inherently want the people. You know what I mean? You want to be able to lead. It's hard to lead when you don't see people. It's hard to make connections. It's hard to know. Yeah, I mean, like, I know everybody's spouse and kids and pets and everything. How do I learn those things if you're not here? How do I take an actual interest in your life if I never meet you? It's very difficult. Okay, last thing, because we're at 3:30. So one of the things I like to talk about is leverage. Okay, and when I talk about leverage, I'm talking about, it's 2022. You can hire anyone to do anything to save you money, right? And sometimes when people think about leverage, they think about, well, if I make X and it would cost me way less than X to do that thing, I should leverage that out, whether it be mowing your grass, blah, 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 whatever. So what is something in business and in personal that you choose to leverage and pay someone else to do? And then what's something that you keep just because you like it? Even though it might not make financial sense for you to do it, you just do it because you like it. This is just a personality thing. I like to learn about, like, what do people leverage? Because, I mean, there's people that are like, everything. I leverage everything. I don't wash my cars. I don't mow my grass. People come and cut my hair. Everybody comes to me because my hourly rate is so high that my ROI is low if I do any of it. And then some people are like, well, I just like mowing my grass.
Yeah.
So I do it. So what are those things for y'all?
I'll let you start.
Oh, man.
What do you pay someone to do at your current age that at 20 you never could imagined you do?
Oh, definitely, work around the house, the grass.
Yeah.
We have help with cleaning the house every couple weeks or so, every 2 or 3 weeks, we have somebody come through.
Yeah.
We don't make much mess, it's just the two of us in the house
Yeah.
nowadays, so we have the bedroom, the kitchen, and the media room. That's what
That's the three places you
what
go.
gets used in our house
Yeah.
nowadays, so we do a pretty good job of maintaining
Yeah.
cleanliness in those.
The other ones are just dusting
Yeah,
because no one goes in there.
Right,
Exactly.
right.
So we'll get help. Yeah, I would say it's around the house, although I enjoy doing, you know, yard work. It is a time factor for sure.
Mm-hmm.
You know, because when we aren't working, you know, and obviously we can work 7 days a week, and you never know, and you can't, especially markets like now.
Yeah.
Things kind of slowing down a little bit already in July and August, which is what we're seeing.
Yeah.
You have to work, whether you got plans Saturday or Sunday or not.
You got to work.
You got a call come in, you're taking the job.
Yeah.
So yeah, I think that time that we do get back from not having to worry so much about house maintenance.
You put it into work.
Is beneficial, yeah.
Yeah, you get ROI on that. Now, what is something that you don't leverage or you don't pay someone to do just because you like it?
I would say for me, from a business perspective, is the numbers,
Okay.
books and production.
Yeah.
It's just more of a, it's not so much of a trust thing. Now, my mom obviously helped significantly with that. She's battling cancer right now, and doing really well, fortunately.
Great.
Yeah, so that came about, I guess, about within the past 4, 5, 6 months. So I've taken on the bookkeeping as well as, you know, bills, bookkeeping, production, and all of those things. But I enjoy it. That's the part that I learned also with business with
Right.
ROM, the company that I was with.
Right.
That part, once I learned about business, I actually went back to UHCL and began working on my MBA. But that's about the time that we were like, okay, look, what we're going to do. We're going to go with it or not, and we decided to go with it. So I stopped pursuing that, which, like we talked about earlier, probably didn't lose any money.
No.
probably wasn't a bad choice, given the cost that it would have taken. But I learned to love the business side of things. You know, the numbers, the data, you know, the trends, all that stuff. So I like that. I could farm that out, and we do. Obviously, we have a CPA that we trust our most, you know, important things too.
Right.
But the day-to-day tracking
Yeah.
and trends,
Yes.
you like to
That's
keep
me,
that.
Yeah. And
Yeah.
our production, and even to the extent of our contracts.
Yeah. Because when I meet
Reviewing contracts and addenda, that's me.
Yeah.
I could.
Because I'll
say
meet.
I do, but I don't.
Yeah. Because I mean, I'll just tell you, I have met with people that they go all the way from I don't farm anything out to I get 6 spreadsheets a day.
Yeah.
And I manage my whole business from 6 spreadsheets. So everything in between I've heard, but I think
I think I might like to be in that position.
well what
But
you always have to have the right people because how do you trust to that point? So yeah, I mean that's ultimate leverage, but I am always interested in the thing that you decide to keep also. So let's go back to you. 20 years old to now. What's something that you never would have thought you would pay someone to do?
Oh, gosh. Well, let's talk about business first.
Yeah.
Because I really, professionally, I believe I've learned to leverage my employees.
Yep.
And in those positions more than I did even 10 years ago when I hired my first assistant.
Is that trust? Is that trust or necessity? Did that start from trust or necessity?
That started from trust.
Okay.
For sure. And where 5 or 6 years ago, I had probably 3 W-2 employees having different positions and job titles. Now it's down to 2. And a lot of that has been trusting, individuals more. And I think it first started with necessity in 2010 or 11, and going back to Beau, he's so great with the numbers, and I never really knew my numbers as a top producer.
Yeah,
and
a lot of them don't.
The assistant at
Too busy
Remax.
working on the next deal.
You're just working.
Exactly.
You're like, look, man, I'm just working. Why you asking me for this
Yes.
data?
Yeah, and Buzzy, my previous broker, who I just adore, he's been very good
Very
to us
successful
over the
business
years,
guy.
And I have a lot of respect for him. Came to me and said, well, gosh, you've just finished 111 transactions. Individually, you're number 3 in the state, and you don't have any help. You don't have a team. So we had that conversation, and where Beau came from necessity in
Yeah.
that position and my first assistant, so.
It just still blows my mind. I mean, you're talking 100 plus
And
deals.
then
One person, 100 deals a year.
no help.
No help.
Yeah.
And clients, I mean, and never dropped the ball.
Yeah.
Clients loved her.
Unfortunately.
Repeat, referrals. I mean, it's just insane.
So I've learned a lot about leverage.
Yeah.
So personally, I mean, I think you just have to go with the girly stuff, you know.
Yeah.
Never think of color my own hair or doing
Yeah.
my own nails or my own toes or,
Yeah.
you know. So just pay people
All
for
that stuff.
maintenance, all
Yep.
that stuff.
Yep.
Yeah. I am very frugal though, and a lot of people don't realize that about me. I recently purchased a new vehicle.
Okay.
And it's a nice one.
Okay.
20 years in the business. I figure I might as well get what I want.
Well, we'll
But-
say that her previous car that she drove, she actually began real estate with, was an Infiniti QX56. And it was like a tank, man. Went through two wrecks. We raised the boys in it. She began her career. And I don't know when you actually, well, until we got this, which was 20.
Yeah. It was
So she drove it for
16 years I drove that vehicle.
225,000 miles.
That's a lot.
Paid off way ahead of time.
Didn't have a car note.
So-
And the reason
so-
was because I was more interested in buying real estate than new vehicles
Sure.
every few
Yeah,
years.
even more so now.
And yes, even more
Maybe
so.
an appreciating asset instead of a
Right.
depreciating asset.
Right,
Imagine
right.
that.
Right.
So we own, I think,
Privileges.
9 properties now, total investment in real estate properties. So a lot of folks don't know that. Tend to be very frugal, but.
She is. Our house needs some updating.
Well, my wife.
This year's the first time we
Yeah.
spent money on our house in a long time.
Yeah. So there's you got to have one of each in every
Yes.
relationship.
Yes.
My wife is very much like, not necessary, don't need that, whatever. And I'm like, well, that'd be fun, you know? So landscaping, pool, all of those things, leverage. I don't do them.
Of
I don't have
course.
time. Don't have time. Don't understand the chemistry. Don't want to keep the
Right.
chemicals.
Yeah, yeah.
Like, it just,
tried
I don't want to do it.
the first month that we had the pool. I was like, all right.
No, I never had it right. Every time I went, it was wrong.
Right.
So you leverage that. That's the stuff that most people are used to. What we've started doing recently, because now we only have one child at home, and then soon we're going to have no children at home, is food. Like, we're starting to order our dinners. Just dinners. Because the time that we get
Yeah.
not making the food,
Yeah.
and we eat a little better, I feel like we're getting return on investment, because it's not incredibly crazy. It's a private person that we know, and she makes just dinners.
Right.
But you know, we know what we're eating. It's good food. We're not eating fast food all the time, which in this business is easy to do.
Yes.
It's very hard to eat right if you're not meal prepping in this business, because you're getting pulled all the time. So that's at 20. If you would have said you're going to pay someone to do your dinners, I would have said you're crazy.
Right.
I will never do that.
Right.
But we do get a lot back out of that. You know, the three of us get to sit down together almost every night and eat,
Yeah.
and that would not happen. That would not happen outside of that.
Right.
That
Makes sense.
So that's one of those things that I never thought I would do. And then the things that I keep are really weird, because I'll just decide, like, I'll do that project, and it's probably going to cost just as much as I would have paid the person, but I'm getting enjoyment out of doing it. But I'm such a perfectionist that it probably took 3 times longer.
Right.
But I'm still fine with it.
Right.
So every once in a while, my wife's like, is this going to be one of those? And I'm like, yeah, I really want to do it. She's like, okay, I'm fine. Let me know if you run into problems.
I get that, too.
But I just get one, I'm like, I think that would be fun to do.
Right.
You know, and she's like, great. It's
Right.
going to happen 3 times longer,
Yeah.
but it will be better. I will take the time to make sure it's perfect.
That's right.
There's something about just pride in completion.
Sure.
And seeing a project
Yeah,
through.
getting it done
you know.
yourself.
Yeah.
Yeah, we get that. We've
Yeah.
been in the same home for 20 years, 21 years now. So we've done a lot of those home projects. Some we leveraged, and others we did ourselves and learned a lot. But yeah.
Yeah. Through real estate investing, I mean, you learn a lot, right? You learn do's, don'ts. Materials don't have to be crazy expensive. You don't have to be married to Brazilian cherry.
Right.
Yeah.
You can put laminate because you can change it. It's not
Right.
that big of a deal.
People still do Brazilian cherry.
Not anymore, but you know it. You and I get the reference.
remember,
The people
right,
in this room
exactly.
get the reference.
Yes.
but
remember the Brazilian.
it had to be this thick, and you had to be able to sand it 15 times, and
Yeah.
that's what they created quarter round for, I think. But
Right.
I'm just saying. But yeah, I mean, you don't have to be married to anything. Everything's changeable. But,
Yep.
and trends go so fast, you know.
Yes, yeah.
We painted our cabinets. Now we're not sure we should have painted our cabinets, or we should paint them a different color. So I mean, it's always changing.
Always.
And if you do flips, you end up liking their kitchen better than yours.
Mm-hmm.
You know, you finish one and you're like, my kitchen sucks. This kitchen is so nice. My kitchen is terrible. And you're like, well, we can't do that every single time. You know what I mean? But
Yeah, we can relate to it.
Yeah, we can. That being on different pages, we've updated most of our home except our master bathroom, and that's because we just can't agree. So it doesn't get updated.
Yeah, by the time we get someone agreement, styles change.
Yeah.
Trends change.
So that's
You guys do the-
last room in the house
you
that's
guys
not been
you guys do the Pinterest boards. Like I like these
I do,
pictures.
And I get, just like any other social media, I kind of get lost with it.
Yeah.
It
Comes
becomes a
around
little
with it.
overwhelming,
Well,
and I can't make a decision.
If you
Yeah,
haven't
I jump on there every now and then. There's some great stuff.
if
on
you
it.
haven't remodeled your bathroom in like 20 years, your fixtures might be coming back.
Oh, yeah.
I'm just saying. I think your
see that.
fixtures might be coming
Yes,
back.
Yes.
Yeah, because we're starting to see all kinds of crazy stuff.
Yeah.
And we see so many appraisals. I'm like, what is going on here?
Mm-hmm.
You know? And then you walk into you walk into some of these and they're just showstoppers. You're like,
Yes.
this house is incredible. And it'll probably still be out of style in 4 years.
Yeah.
Yeah, that's right.
And you can spend so much money on it. And it's just
Mm-hmm.
Yeah, they do change fast.
Yeah.
Things change.
so
And
fast.
remember, I'm frugal, so.
Yeah, so you're like,
he wants
not
to be in our
happening.
master bathroom.
Yeah.
Some more
I'm
change.
like, oh, we can get away with this.
Yeah.
Yeah, it does. But we've made it 31 years of marriage and 28-year-old twin sons and our first grandson now.
Twins are my wife is a twin. Runs in her family. Yeah, my wife's a twin. And we are having our 20th anniversary in 13 days.
Congratulations.
Thank you. Yeah. We'll officially have been married longer in our life than we haven't.
I remember that.
Right.
Yeah.
I remember
This
that.
is the year. This is the year that it teeters for us. So
Yeah.
we were early too. We just together from a very young age, and it doesn't always work out for people, but you know, she's a really great partner. That makes it a little easier because you know, it's not, you know, a lot of people call it quits, but she's an amazing support person. Like every dumb idea I have to risk everything, she's okay with it. And you know, without that, it's always the pressure is in the back of your mind if it's not the level of support that she gives. So I appreciate that from her.
I can totally relate, and I think it's the heart of a nurse.
It must be.
It's the heart of a nurse.
It's a caretaker's
Yes,
heart.
Yes.
Yeah.
It's taking care of
Maybe
me.
so. Maybe it's kind of like, man, it's really not that important. I mean, we're talking about life and death here.
Right.
Which is from a nurse.
It is.
You're
you
like-
said that
You're like, every
before.
time I'm doing something, it's someone's life, and I'm like, I don't know if I should take this business risk. And you're like, who cares?
Yeah.
Roll with
We're
it.
dealing with big numbers.
Yeah.
You know, transactions.
Your margins
but-
change.
Yeah. Yeah.
Yeah.
And
The
it does.
decimals change.
Affect it
Mhm.
Yeah.
just a little bit.
Still playing the same game though.
He is reminding me that
Yeah.
sometimes, yes.
Yeah.
Well, I appreciate you guys so much for coming.
Good stuff. We enjoy
It's
it.
always fun to dig in with a new person, and I loved hearing your story. And anything that we can do, if you want us to jump on and talk about that one product with your team, we're happy to do it. Just because I want to educate people on that. And when we have this stuff ready for you, we'll get it sent to you. But I really appreciate it.
Well, we appreciate you.
Got a lot of
inviting us.
parallels.
Yes.
Sounds like
It's really
yes,
cool.
We do.
Yeah.
Yeah.
Yeah, we appreciate you having us and the opportunity, and I feel like I learned a lot today about you personally.
Yeah.
And
Right.
the business aspect and your products, so.
Same thing.
I enjoy it as well.
Yeah, well, it's been cool watching you guys grow and all of your stuff from over here, because everybody notices you're paying attention, and you know, we want to get the perspective of people that have been here a little bit. I want to get the new people's perspective too, because I want to know what they think. But across the board, you know, I appreciate you guys accepting the invite.
Yeah.
Means a lot to me.
Yeah.
It's an important project to me, so I appreciate it.
Absolutely.
Very
We're-
much.
We're happy to be a part of it.
Yeah.
Yeah.
Glad you guys thought of us.
Yeah, absolutely.